Have you ever heard people talk about stocks, PE ratios, dividends, ETFs, and thought, what language are they even speaking? You're not alone. The world of investing has its own dictionary, and if you don't know the basics, it feels impossible to even start. But here's the good news. Once you understand these key terms, investing becomes a whole lot less scary and actually kind of exciting. So today, I'm breaking down 15 of the most important investing terms every beginner should know in 2025. By the end of this video, you'll be able to join in on those conversations, understand what financial YouTubers are talking about, and most importantly, use this knowledge to grow your money. Let's get started. First, stocks. A stock is simply a share of ownership in a company. Imagine Apple is a giant pizza. Each slice of that pizza is one share of Apple. If you own a slice, you literally own a piece of the company. When Apple grows, sells more iPhones, and earns more money, your slice usually becomes more valuable. But if the company struggles, your slice shrinks in value. Owning stocks is how millions of people build wealth. But it also comes with risk because you're betting on a company's future. Second, bonds. Bonds are like loans. If the U.S. government or a big company wants to borrow money, they don't go to a bank. They come to investors like you. You give them money, and in return, they promise to pay you back with interest. Bonds are usually considered safer than stocks, but they also don't grow as fast. Think of bonds like the steady and reliable friend in your investment portfolio. Third, dividend and dividend yield. A dividend is when a company shares part of its profit with shareholders. For example, Coca-Cola has been paying dividends for decades. If you own their stock, you get paid every 3 months, just for holding it. But here's where it gets technical, the dividend yield. This tells you how much income you're earning compared to the stock price. If a stock is $100 and pays $4 in dividends per year, that's a 4% yield. High yield sounds good, but be careful. Sometimes a super high yield means the company is in trouble. 4. ETF, Exchange Traded Fund. Think of an ETF like a fruit basket. Instead of buying just an apple, one stock, you buy the whole basket with apples, bananas, and oranges, which represent lots of different companies. ETFs are great for beginners because they spread your risk across dozens or even hundreds of stocks. Popular ETFs like the S&P 500 ETF, VOO, or SPY hold the biggest U.S. companies all in one. This means even if one company struggles, your basket stays strong. 5. Mutual funds, similar to ETFs, but instead of buying and selling them all day, you can usually only trade them once per day, after the market closes. Also, mutual funds are often managed by professionals who pick stocks for you. That can sound nice, but it usually comes with higher fees, which brings us to 6. Expense ratio. The expense ratio is the annual fee you pay to own an ETF or mutual fund. For example, if you invest $1,000 into a fund with a 1% expense ratio, you're paying $10 per year in fees. That doesn't sound like much, but over decades, high fees can eat away thousands of dollars from your returns. That's why smart investors love low-cost funds like Vanguard or Schwab ETFs, where fees are often below 0.1%. 7. Market cap. Market capitalization, or market cap, is simply the total value of a company. You take the stock price and multiply it by the number of shares. For example, Apple's market cap is around $3 trillion. That makes it a mega cap company. A small startup worth $500 million would be called a small cap stock. Market cap helps you understand whether a company is huge and stable or small and risky. 8. PE ratio, price to earnings ratio. This one sounds complicated, but it's really not. The PE ratio compares a company's stock price to its earnings. Think of it like buying a rental property. If the house costs $200,000 and it makes $20,000 per year in rent, the PE would be 10, price divided by earnings. For stocks, a lower PE might mean the stock is cheap. or it could mean investors don't believe in its future. A higher PE means people are willing to pay more for every dollar the company earns, often because they expect growth. 9. Bull market versus bear market. A bull market is when prices are rising and investors feel confident. Picture a bull charging upward with its horns. A bear market is when prices fall 20% or more and investors are fearful. Picture a bear swiping down with its paw. These cycles happen again and again in investing, and the key is not to panic when the bear shows up. 10. Portfolio. Your portfolio is simply the collection of everything you invest in. If you own Apple stock, a bond, and an ETF, that's your portfolio. Think of it like a backpack filled with your investments. Some heavy textbooks, big stable stocks, some snacks, small riskier stocks, and maybe a water bottle, cash. Everything together makes your portfolio unique. 11. Diversification. The old saying is true. Don't put all your eggs in one basket. If you invest only in Tesla and Tesla has a bad year, your money suffers. But if you spread across Tesla, Coca-Cola, Microsoft, and an S&P 500 ETF, you're diversified. Diversification reduces risk. It doesn't eliminate it, but it makes your portfolio much stronger. 12. Liquidity. Liquidity means how quickly can you turn an investment into cash. Stocks are very liquid. You can sell them in seconds. Real estate is not liquid. It might take months to sell a house. When building your portfolio, it's good to know which investments are easy to access and which ones lock up your money for a long time. 13. CAGR. Compound Annual Growth Rate. This is a fancy way of saying, how much has my investment grown per year on average? For example, if you invested $1,000 and it grew to $2,000 in 10 years, your CAGR is about 7.2% per year. It smooths out all the ups and downs into one average number, so you can compare different investments more easily. 14. Volatility. Volatility measures how much the price of an investment goes up and down. If a stock bounces from $50 to $100 back to $60 in 1 month, that's high volatility. If another stock slowly goes from $50 to $52, that's low volatility. High volatility means big risks and big rewards. Low volatility means steadier, calmer growth. 15. Dollar cost averaging, DCA. Instead of trying to time the market, which nobody can do perfectly, dollar cost averaging means investing a fixed amount regularly, like $100 every week. Sometimes you'll buy when prices are high, sometimes when they're low, but over time, it averages out. This strategy is one of the simplest and most effective for beginners because it builds discipline and removes the stress of guessing the perfect moment. Remember, learning the language of money is the first step to making your money work for you. If you found this helpful, drop a comment telling me which term finally clicked for you today. And don't forget to subscribe, because this is just the beginning of your investing journey.